Hare Krishna. Welcome to Tax YouTube channel. This is CA Rohanar Pingle, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. And today we are going to discuss on a special topic that is on FAQ related to transition from old act to new act. Yes. If you have seen or gone through, department have provided us FAQs, that is a 100-page document on the transition from old to new act. But in today's session, I have compiled it and made it in a 10 page slide. So let's have dive into it and let me allow to share my screen. You will definitely useful for all of us. So let's start with it. Yes. Summary of FAQs from transition of income tax old 1961 to the new income tax 2026. So we will cover it 10 key topics like philosophy, payments, returns, forms, reassessment, TDS, then 536 sections, that is new act versus 819 sections in the old act. And the effective date of the new income tax act is 2025, comes into force on 1st April 2026. So let's see what we are going to discuss today. We will discuss 10 topics like philosophy behind the transition, the tax payments, furnishing of income tax returns, other forms and compliance, reassessment of income, escaping assessment, TDS compliance, appeals, revision, set off and carry forward of losses, issue concerning non-resident Indians, and miscellaneous provisions. Means what we are covering here is that the summary of FAQs document, that is a 99-page document. We have covered it almost. What is the important things to know? What are the effects or impacts? Whatever questions we are comes into the mind, that I have compiled it in this 10-page document. So all content is based on the official FAQs that is available on the income tax department side. So let's start with it first. The philosophy. So new act aims to present what same tax policy in a more logical, accessible and reader-friendly format. Old act repealed. However, transitional provisions specify what continuation of the proceedings under the old act. So new Income Tax Act 2025 doesn't impose any new tax. That is very good for all of us. So new act contains 536 sections and 16 schedules, whereas old act contains 819 sections and 14 schedules. So new income tax rules 2026 contains how much? 333 rules and 190 forms, whereas old income tax rules 1962 contains what? 511 rules and 399 forms. So almost half of the done in a new act. So structure of chapters reorganized in a more logical sequence. Concluded proceedings in an earlier act still valid. Pending proceedings would continue as per the relevant transitional provisions. Charge of income tax is on total income of tax year. Okay, from the tax year 26-27. So tax year can be less than a financial year too. So section 536 repeal and savings clause contains what? 22 sub clauses, various transitional situations that you can go through and read. So right, benefits, obligations, liability arose under the old act continue to exist. Okay. Please note down all these things if you want, or you can take a screenshot of this PPT. So old approvals, registrations, and recognitions would be valid if they are not inconsistent with the provisions of the new act. So old circulars, instances, and notifications are still valid as long as they don't conflict with the new act. Moving further under tax payments collection and refunds, new act doesn't modify the framework of governing the manner of the tax payments, that is TDS, TCS, advance tax, self-assessment tax, or modes of even remittances of taxes remains unchanged. So no change in policy with respect to TDS provisions, only present TDS provisions in a simple and a tabular manner. Any sum paid or credited on or before 31st March 2026 shall be governed by old Act and thereafter new Act from the quarter one. So new sections should be quoted for TDS or TCS made after 1st April 2026. Please note down this and be careful while you are going to pay TDS for April 26 in the month of May. So that time, if it is in the current tax year, then you have to select a new section, new challan for paying or depositing the TDS or TCS to the government treasury. So that need to be very careful. For old act, still old challans, old sections need to be specified, and that portal will handle both the situation. So applicable section for contracts or services spanning over the period of March, April 2026 will depends on the mechanism of event earlier of the credit or payment. So due date of payment to the government account within the same timeliness without any policy change. If tax is deducted under the 1961 Act prior to the transition date, then deposit obligations will continue under the 1961 Act. Thus, existing challans and payments codes linked to the old Act continue. That as I have said you earlier. So the interest rates applicable for defaults in deducting or depositing the TDS or TCS remain unchanged. There is no change in that. No policy changes regarding the provisions related to the payment of advance tax under the new Act. The quarterly installments, dates, and quantums remains the unchanged. Everything is same. Threshold for payment of advance tax unchanged. That is tax payable rupees 10,000 or more. That is the threshold limit for that. The interest rates applicable for defaults in payment of advance tax remains unchanged. Annual information statement will continue. It will stand replaced by form number 168. Any unutilized credit for MAT or AMT allowed to be carried forward. If a tax deductor was entitled to claim a refund under the old Act for any tax year prior to the commencement of the new Act, he still remains entitled to that refund even after the new Act comes into force, subject to the condition that the refund claim is filed within stipulated time of 2 years from the end of the financial year in which tax was deductible. So this claim is required to be filed in form number 26B of Income Tax Rules 1962. So please note that the period to claim refund need to be filed, that claim is 2 years from the end of the financial year in which the tax was deductible. Moving further, let's understand what are the FAQs answered by furnishing under the furnishing of income tax returns. So section 263 of the Income Tax Act 2025 contains the provisions for original return, belated return, revised return, and updated return. What is the section? Section 263 of the Income Tax Act 2025. Earlier it was section 139. So no change in the obligation to file the return of income under the new Act, that is which person must mandatorily file a return, remains the same. Due dates are the same as under the old Act. ITR for income earned during the financial year 25-26 will be filed for assessment year 26-27 under the provisions of which Act? Income Tax Act 1961. So the revised return for AY 26-27 will be governed by which Act? Income Tax Act 1961. Taxpayer can file an updated return, that is ITR-U, for AY 26-27 under the old Act even after the new Act comes into the force. So revised or belated return for AY 25-26 or an earlier assessment year cannot be filed after 1st April 26. Please note down that. Revised or belated return for AY 25-26 or an earlier assessment years cannot be filed after 1st April 26. That is the over. The time limit is over. Now we cannot file revised or belated return for AY 25-26 or an earlier assessment year. So, however, taxpayer may still file his updated return subject to the time limits prescribed under the old section 139(8)(a) of the old Act. Updated return can be filed within 48 months from the end of the financial year succeeding the relevant tax year. That is the under New Income Tax Act we are talking about. That is updated return can be filed within 48 months from the end of the financial year succeeding the relevant tax year, means effectively 5 years. Okay, it is available whether or not the person has furnished an original, belated or revised return. The updated return cannot result in return of enhanced loss or decrease in total tax liability or increase in refund. So only one updated return can be filed per tax year. Only one updated return can be filed. Please note down. If a search is initiated on a person under the old act, but notice for filing return of income issued after 1st April 2026, even then return of income is required to be filed under the old act. The scrutiny assessment for AY 26-27 or any earlier year will be completed under the provisions of the Income Tax Act 1961. If a taxpayer incur a loss in FY 25-26, that is AY 26-27, this loss can be carried forward under the new act. The unabsorbed losses from earlier years that are being carried forward under the old act will continue to be carried forward under the new act subject to the same conditions, that is type of loss, period of carry forward, etc. There is no substantive change in the manner of verification of the return of income or as regards person who is required to verify the return under the new act. So that is related to furnishing of the return of income. Let's move further. Other forms and compliance statements. The PAN application forms being used in the framework of Income Tax Act 2025 have been restructured. The form numbers for corresponding form 49A is now 93. For 49A, it is now 94. For 49AA is now form 95. And for 49AA, form number 96, that is 95 or 96, that is, it is split into individuals not being citizen of India and entities incorporated or formed outside India. So earlier 49AA used is only one, but now it is split into the two forms, form 95 and form number 96. So old single TAN application form 49B has been split into two forms, that is form 134 and 135, government entities and other than government entities respectively. Form number 97 under the new act replaced the earlier form number 16, that is the non-PAN holder. However, there is some change in the scope of the transactions mentioned in the new rule 159 sub rule 2 as against the transactions mentioned in the rule 114B and 114BA of the IT rules 1962. So form 15G, 15 is now combined in one unified form, that is 121. The substantive requirements furnishing information about the remittance, obtaining CA certificate for amounts exceeding the prescribed threshold, ensuring TDS compliance remains the same. Nothing has been changed on that ground. Taxpayer filing Part B of Form 145 with AO certificate are not required to obtain Form 146 from a chartered accountant. This is a significant reduction in the compliance burden and cost remittance. That is the only change. Earlier, who filed in Part B also need to take a CA certificate in Part C. Now that has to be removed. So taxpayer filing Part B of Form 145 under the new Act with a AO certificate are not required to obtain Form 146 from a chartered accountant. Okay, so all three erstwhile audit forms, that is formed under the tax audit form, that is 3CA, 3CB, 3CD, have been consolidated into a single smart unified new form, that is form number 26, with a structured and standardized reporting. A provisional approval granted to a charitable organization under the old act shall not be invalid merely because the new act comes on 1st April 2026. Therefore, it will be continued. Sorry. All application freshly filed on or after 1st April 2026 shall be governed by the Income Tax 2025. Moving further, fifth topic, let's understand under the FAQs under the reassessment of income escaping assessment. Here, the AO shall not make any assessment, reassessment, or recomputation under section 279 without issuing a notice under section 280, which is corresponding to the section 148 of the Income Tax Act 1961. Section 279 and 280 is from New Income Tax Act 2025. The provisions of the repealed act shall continue to apply to any proceedings pending on the date of the commencement of the new act. Please note down this. Provisions of the repealed act shall continue to apply to any proceeding pending on the date of the commencement of the new act. Therefore, reassessment proceedings already initiated under the old act will continue to be governed by the provisions of the Income Tax Act 1961. Even after 1st April 2026, proceedings such as assessment, reassessment, rectification, penalty, revision can still be initiated and completed under the old act for earlier assessment years till the AY 26-27. If a notice under section 148A subsection 1 of the old act was issued before 1st April 2026, but the notice under section 148 is yet to be issued, still it can be issued after 1st April 2026 under the provisions of old act. Since the assessment proceedings for AY 26-27 or for any earlier assessment years are governed by old act, the approval hierarchy prescribed in section 151 of the old act still will apply for that particular thing. Any proceeding for imposition of penalty for any tax year beginning before 1st April 2026 may be initiated and the penalty imposed under the old act as if the new act had not been enacted. So moving further, let's see TDS compliance. The deductor applies the old act for all payments or credits up to and including 31st March 2026 and will apply the new act for payments or credits from 1st April 2026 onwards. So there is no need to amend the contract merely because the new act is commencing on 1st April 26. The deductor is required to apply the applicable TDS provisions based on the date of the credit or payment, whichever is earlier. So TDS rates and monetary thresholds for all categories of payments have been retained as it is. They are under the income tax. They are in the Income Tax Act 1961. So there is no change in that particular area. Citing the old section number, for example, section 194C instead of new section 393 subsection 1 table serial number 6I may lead to processing errors at the time of filing the TDS return. So in this month from now onwards, whenever we make a new challan or a payment, whatever, we need to put the correct section of the new act. If it is applicable to the new act, we need to select correct tax year, collect proper correct challan, that is if it is applicable under the new act. Otherwise, it will be trouble while you are filing your TDS return of the first quarter in the month of July. So in such cases, the deductor may require to submit a correction statement to rectify the section reference. So please, so now for the first, at least first or second, up to the second quarter, we need to be very careful while quoting the sections, while selecting the challan, selecting the tax year. So we need to update our accounting staff also, or client's accounting staff also. So correction statements for quarter 1 to quarter 4 for financial year 25-26 or earlier must be filed under the framework of Income Tax Act 1961, that is old act. For transactions where the event of credit or payment occurred on or after 1st April 2026, the challan cum TDS statement is required to be filed under the new Act 2025. Corrections to TDS returns for periods governed by the old Act can be filed even after the new Act has come into force. That is, portal will help us, or portal will support both these transitions, okay, for the current year. So such correction statements can be furnished within a period of 2 years from the end of the tax year in which the original statement was due. Now, moving further under appeals, revision, and alternate dispute resolution, there is no structural change in the appellate hierarchy under the Income Tax Act 2025. The architecture of the appellate remedies remains intact and continues in the same sequential manner. If you are watching on the screen, that is assessing officer, JCIT or CIT appeals, ITAT, High Court, and then Supreme Court. So the limitation period for filing the appeal in Income Tax Act 2025 as against Income Tax 1961 has remained unchanged. No change over there. Pending appeal as on 1st April 2026 shall continue and be disposed of in accordance with the provisions of the Income Tax Act 1961. No new appeal needs to be filed. Where the time for filing an appeal, revision, reference had already already expired before the commencement of the new act, such right cannot be revived merely because of the new act prescribes a different or extended limitation period. If the ITT remands a case on or after 1st April 2026 in a respect of AY 23-24, the remand proceedings will continue to governed by the old act, that is Income Tax Act 1961. No substantive structural change has been made in the Dispute Resolution Committee framework. No substantive or procedural change has been introduced in the advance ruling framework under the Income Tax Act 2025. A pending advance ruling application shall continue before the competent authority as constituted under the law then in force. The Income Tax Act 2025 doesn't disturb the pending advance ruling proceedings. A revision application filed under Section 264 of the Income Tax Act 1961 and pending as on 1st April 2026 shall be disposed of under the provisions of the Income Tax Act 1961 only. So moving further, set off of carry forward of losses and deductions and non-residence provisions. First, no change in the fundamental principle of set-off and carry-forward of losses under the Income Tax Act 2025. The core architecture remains the same. Losses are first adjusted intra-head, that is within the same head of the income, and then enter-head, that is subject to the statutory restrictions, after which the balance, if any, is carried forward. The duration for which loss can be carried forward also remains unchanged. Losses brought forward for tax years beginning from 1st April 2026 shall continue to be carried forward for the remaining period and set off under the new act in the manner provided under the corresponding provisions of the repealed act. If an amalgamation took place in the financial year 2024-25 under Section 72A of the Income Tax Act 1961 and the prescribed conditions are violated for FY 26-27, then the amount shall be deemed to be the income of the amalgamated entity in the tax year of the violation, that is 26-27, and therefore accordingly the deemed income arising in the tax year 26-27 will be chargeable to tax under the Income Tax Act 2025. We note down this. So Income Tax Act 2025 doesn't reclassify losses determined under the Income Tax Act 1961 into different heads of the income. Section 123 of the Income Tax Act 2025 retains rupees 1.5 lakh aggregate deduction for specified savings instruments for individuals or HUF, that is structurally similar to the Section 80C with 80CC E of the old Act 1961. Where a profit linked deduction under Section 80IA of the Income Tax Act 1961 was allowed for certain number of years, then the assessee continued to claim it after 1st April 2026, but only for the remaining period and in manner as provided in the original Income Tax Act 1961. So now let's see issues concerning non-resident Indians. So no change has been made in the basic conditions for determining the individual residency. The special relaxation continues without any change. Rule for Indian citizens or persons of Indian origin visiting India has not been modified in the new act. Deemed residency rule has been retained in the Income Tax Act 2025. There is no modification in the not ordinary resident criteria. The residency test for a company has not changed under the Income Tax Act 2025. The core features of the special NRI taxation regimes remain unchanged. Written filing exemption for NRIs under the old Act has been continued in Income Tax Act 2025. Income Tax Act 2025 retains this elective mechanism allowing the assessee to declare in the return that the special provision shall not apply. Means that is also continued. Upon such declaration, taxation shall be under the general provisions of the Act. The voluntary nature of the special regime therefore remains intact. Nothing has been changed on that ground. Moving further, let's understand our today's last topic for the discussion, miscellaneous provisions. In the Income Tax Act 2025, the new tax regime is provided under the Section 202 and is available. An option exercised under a provision of the old Act, as was in force immediately before the commencement of the new Act, is treated as if it was made under the equivalent provision of the new Act. In the Income Tax Act 2025, all the presumptive taxation schemes have been consolidated into one section, that is Section 58, in a tabular format while adopting the simplified language, and that are also intact. If a search was initiated on a person under Section 132 of the old Act before the new came into effect, all proceedings connected with such search continue to be governed by which Act? Old Act. So as if the new Act had not been enacted. And general anti-avoidance rules, that is GAR provisions, are written as it is. Thresholds, approval mechanisms, and procedural safeguards remains also unchanged. So that's it for today. Thank you. Thank you so much for patient hearing. If you have any questions, observations, suggestions, then please do let me know via WhatsApp, email, or you can also comment below the video. Okay, if you have not yet subscribed Tax Guru YouTube channel, then do subscribe for latest updates and video series like this. Hope you are gaining valuable knowledge from all such updates and video series which we are conducting on the Tax Guru YouTube channel. Stay tuned to the Tax Guru YouTube channel and share this particular video as much as you can so that the professionals, the accountants who are in this particular type of service can benefit it from this. So thank you so much once again. Bye bye. Take care. See you soon. Hare Krishna.